Okay, in the last section, we left off introducing the idea that valuation plays a critical role in restructuring analysis. Specifically, in our example, we had the lower priority subordinated lenders preferring a high valuation, and presumably they would be arguing for a higher valuation for the business because that would provide them some sort of recovery. And in sort of a broad sense, that's generally the case in bankruptcies and restructuring. The lower priority folks are arguing for higher valuation because it implies that they might participate in some of the recovery. So in this section, we're going to talk about valuation in a little bit more detail and talk about how first bankruptcy draws heavily on standard valuation methodology. So those of you who have a banking background or are familiar with basic corporate finance methodologies, this is going to be fairly familiar. There are some differences in terms of how those methodologies are used, what some rules of thumb are that are specific to bankruptcy and restructuring, and that's what we're going to talk about. So first, the discounted cash flow analysis, or the DCF, is a prevailing methodology, not just for many areas of corporate finance, but also restructuring. And the idea behind the DCF, as I suspect many know, is that the value of a business is a function of future cash flows discounted at a rate that appropriately reflects the riskiness of those cash flows. Now, comps analysis is sort of the other, common pillar of valuation, and that's another way to value a business. And comps analysis, also called multiples analysis, or relative valuation, suggests that the value of a business can be imputed by observing market valuations of comparable firms relative to a relevant operating metric like EBITDA, and using this multiple to frame a value range for the company under the analysis. A variation of this approach is called comparable transaction analysis, and that values a company based on the multiples that have been paid to acquiring comparable businesses. Typically, the multiples are EBITDA. It could be revenue, could be EBIT. For non-restructuring companies, it could be price to earnings as well. But typically, you're going to see EBITDA as a very common multiple used in both comps, trading comps, and transaction comps. So let's talk about the DCF really quickly. Basic methodology is forecast the free cash flows, typically forecasted for 5 to 10 years, and then you calculate sort of beyond the initial forecast period, you calculate what's called the terminal value, which represents the present value of all the present value as of the final forecast year of all future cash flows, and sort of this lump sum present value. And then you discount both of these cash flows, both the explicit forecast period as well as the terminal value. You discount both those from whatever the last explicit forecast year is back to the present using a weighted average cost of capital, which reflects the cost to all providers of capital. That in turn equals the enterprise value. That gives you the value of the company's net operating assets. And in the first section of this primer, we talked about sort of what does that actually represent? What does enterprise value represent, and how does that sort of relate to the fundamental accounting equation? For those that are not familiar, the free cash flow calculation for an unlevered analysis like this, in restructuring, it's always going to be an unlevered analysis where you forecast cash flows without any effect of leverage, without any effect of debt. And this is how you calculate unlevered free cash flows. You basically start at EBIT, you tax affect EBIT, and then you make a whole bunch of adjustments to reflect that, to go from essentially accounting tax affected EBIT to cash flows. Biggest add backs are the addition of depreciation and amortization, and making adjustments for changes in working capital, subtracting on capital expenditures and any other required investments. And you could think of this as a transition. Those who are comfortable with the cash flow statement, this is if we start with net income in the cash flow statement, all these add backs get us to cash from operations less cash from investing activities effectively. Okay. A couple of things to keep in mind in the DCF. There is no consensus on implementation. There are controversies over how to estimate this cost of capital. In fact, in a restructuring, many of the objections on valuation grounds that perhaps in our case the subordinated lenders would make is they say, hey, the discount rate that you're using to arrive at 290, is incorrect. You're using a very high discount rate. You should be using maybe a lower discount rate, which will get you that higher valuation that we're looking for. It's also extremely sensitive to changes in operating, exit, and discount rate assumptions. So in order to calculate this terminal value, as we'll talk about shortly, you have to make a lot of broad assumptions about how this business will operate beyond the 5 to 10 years. You also have to make, just in order to get these, first 5 to 10 years worth of forecasts, you have to make a lot of really broad assumptions about what's going to happen to margins, what's going to happen to the, to this company's, revenue, the growth in our case of rental income, et cetera, et cetera. So it's so extremely sensitive to these operating, exit, and discount rate assumptions that what ends up happening is that there's broad room for having these types of valuation disagreements, and it actually forces folks to, or it creates an incentive for folks to negotiate together, so that the subordinated lenders in our case and the senior lenders can come to some sort of agreement. So it doesn't boil down to this valuation type of fight. So in terms of cost of capital, obviously, this primer is the goal is not to really dive deep into what a cost of capital analysis is. This could be the subject of full semester of corporate finance. For those who are not familiar with the basic DCF concepts, I encourage you to go through our DCF course. For our purposes here, what I will say is, as a rule of thumb, most investors in distressed debt require a return in the range of 15 to 25%, and that usually serves as the discount rate for a business that's in distress or in bankruptcy. Terminal value calculation. Intuitively, this should reflect the present value of all cash flows beyond the explicit forecast period, as we mentioned. The terminal value can be derived in two ways, really. The first way is using what's called a growth in perpetuity formula. And in that approach, the terminal value simply equals the next year. So the terminal value, say, 5 years out from now. So today, now it's 2012. So the terminal value for a company in 2017 equals the free cash flows in 2018 divided by that WACC, that 15 to 25%, minus some long-term growth rate. Now, that long-term growth rate, rule of thumb for companies in distress, is 0 to 4%. And this should represent a sustainable, constant long-term growth rate that we believe this company can sustain forever. And we talked about the constant discount rate. And so that's the formula. And obviously, a lot of assumptions go into play here. You're going to get a widely different terminal value if you assume a 0% G or if you assume a 4% G. You're going to get a very different terminal value if you assume a 15% WACC versus a 25% WACC. And depending on the forecast that you make up until 2017 and including 2018, you're going to have some broad ranges potentially for what those free cash flow figures are. So hopefully you're getting a sense of how, where there's a lot of room to go from 290 to 600, for example, in our example for valuation. There's an alternative approach for calculating terminal value, and that's called the EBITDA exit multiple approach. It's used to calculate the terminal value simply by assuming, I should say, an enterprise value at some multiple of EBITDA in the terminal year. So basically we're saying, okay, when we get to 2017, let's just assume that we can sell this business at 5 times whatever the EBITDA is for that particular year. And since we've done an explicit forecast, presumably, let's go back, we had done an explicit forecast up till the terminal value year, we will have had EBITDA that we can use to multiply by some assumed multiple, which presumably comes from some comps analysis. And that's a somewhat easier way to arrive at terminal value, rather than, I wouldn't necessarily say easy, but certainly a more easy to justify way than to somehow hang your hat on some sort of long-term growth rate. And so what you end up seeing a lot, especially in investment banking, the EBITDA multiple approach tends to actually be a more common presentation in valuation to justify certain restructuring values. Okay, so let's just bring it to our prior example and see how perhaps a DCF analysis would justify the $290,000 that those senior lenders ascribed as a value for our business. So in our prior example, suppose that the senior lenders, in trying to justify that $290,000, as well as perhaps the debtor, the owners who were supportive of that senior lender valuation, suppose that they had hired an investment bank who projected free cash flows related to the investment properties using the growth in perpetuity approach, They assumed a WACC of 20% and a long-term growth rate of 4%. And these were the free cash flows that they had calculated. They discounted those to the present and they got 140. Plus, they also calculated a terminal value, which is to say, hey, 2015 free cash flows. Remember, the terminal value perpetuity formula says take not the last explicit year's forecast for free cash flows, but the following years, which oftentimes is simply just taking the last year's forecast, growing it by 1 plus G, which will get you that 60.1. And then if you divide that by WACC minus that G, so 20 minus 4, you'd get 375. And then if you discount that 375 back to the present at that 20% WACC, you get 151. 151 represents the present value of the terminal value today. Plus, we have the present value of the free cash flows today. You add those two up and you get 290. So presumably, this is one way in which perhaps a free cash flow and a DCF analysis would have justified the 290. One other alternative is using the EBITDA multiple approach. So using an EBITDA multiple assumption, you could arrive at a similar value. Presumably, let's say that the investment bank that's helping the debtor and the long-term lenders or the senior lenders arrive at a valuation, did a comps analysis, and they believe that this company should trade at a 4.7 times EBITDA multiple when they exit from 5 years out. And so similar explicit forecast period, right? Same as in the prior year. But we also have here that the analysis, we also have a line for what EBITDA would be in that forecast year. And we can calculate a terminal value. Instead of using the growth and perpetuity approach, we simply say, okay, well, the last 12 months, that's what LTM stands for. Well, the last 12 months EBITDA was 80.5. Well, why don't we just multiply that 80.5 by this assumed multiple that we presumably have backups for through a comps analysis. And we get to 374. If we discount that to the present at the 20% WACC, we get 150. We add that 150 to the 139. And yet again, we come up with something close to 290. And so this would be yet another way to actually arrive at a $290,000 valuation. And those of you who are wondering, those of you who do not have experience in investment banking may be wondering, this seems a little bit backwards. It seems like, in the example that you're suggesting, you're trying to sort of arrive backwards at a presumed notion of what valuation is, as opposed to the other way around. Well, there is actually some reality to that. There are going to be some preconceived notions by the senior lenders about how they want value to look. And although this may seem a little bit cynical, but since you have so much leeway in terms of the assumptions that you make, an investment bank that's advising a senior lender, being quite cognizant of the interest of its client, may certainly make assumptions that support that type of valuation. That's that's a fairly cynical thing to suggest. Unfortunately, there's a little bit of truth to that. That's not always the case. It may be that the investment bank you retain says, after all, we put in these assumptions, we think a value really is closer to 400. But quite often, it seems like the interest of the client very much sync up with what the valuation opinion ends up being of the appraisers or the investment bank that the clients retain to represent them. Lastly, one thing that's interesting is the exit multiple assumption here. This represents the multiple that we think that we will be able to exit this business out, that we will be able to sell this business for, hypothetically 5 years from now. The $290,000 value, if you compare that to today's EBITDA, you're actually looking at an EBITDA multiple of 7.5 times. So just don't confuse EBITDA multiples. The exit multiple should represent the multiple you think you can sell the business out at, at the end of the explicit forecast period. Again, the primary question in when you're thinking about these assumptions is what is an appropriate terminal EBITDA multiple. And another rule of thumb is important in the sense in the context of restructuring. Given that the return requirements for distressed investors is 15 to 25%, and a commonly acceptable sustainable growth rate range assumption is in the 0 to 4% range, you could actually sort of back into what that implies about potential EBITDA multiples. And in restructuring, what you'll typically see is the exit EBITDA multiples that are used by investment banks and their models is anywhere between 4 to 8 times. Analysts should recognize the deviations away from this multiple range imply deviation from these benchmark discount rates and growth rate assumptions. That's actually an important point. We're going through these assumptions very quickly. And for those who haven't gone through the DCF, for those that are interested in really understanding how the EBITDA multiple is actually sort of conceptually connected to these growth rates and these discount rates, I do encourage you to either go through our discounted cash flow modeling course, which covers this kind of stuff in great detail, or go through any other corporate finance text, a corporate finance academic text, maybe perfectly sufficient to sort of explain conceptually the connection between these EBITDA multiples and these growth rates and these various methodologies. Again, the advantages and the disadvantages of the DCF are fairly well known. The advantages of the DCF, as opposed to say doing a comps analysis, is that discounting future cash flows is an intuitive way to value a business. So when you're thinking about the value in our example of $290,000 or $600,000, whoever ultimately wins out, the most intuitive way to think about the value of our business is going to be look at what is the future rental income that these businesses, the properties that we own in our portfolio, could generate, and minus costs and discount those to the present. So it's an intuitive way to value a business. It does also provide context to any market-based valuations. Of course, there's always the argument that the market is wrong, potentially wrong about how they're valuing your business. Or if you're dealing with a private company, you don't actually have market-based valuations. And so this provides some sort of sanity check to that, as well as the advantage that it can be adjusted to reflect bankruptcy-specific adjustments to cash flows. Disadvantages are that it's highly sensitive to various assumptions about the distant future. I can basically say anything I want is sort of the cynical argument against the DCF about what this company is going to look like 3 to 4 years out. I have this broad range of discount rate assumptions that are considered acceptable. I have this broad range of terminal value assumptions that are considered acceptable. And so those are probably the biggest and very legitimate knocks on the DCF. Lastly, it also requires access to detailed historical financials to really get some sort of frame, some sort of baseline for the projections that we would ultimately have to make in a DCF. Again, so that's the DCF. Those are the pros, those are the cons, and we're going to talk about sort of the other prevailing methodology for valuing distressed businesses, and that's comps. Given the limitations we've talked about with the DCF, professionals often also determine the enterprise value of a distressed business based on values of comparable companies. And some of the more common multiples in restructuring that are used to value a business are enterprise value to revenue multiples, enterprise value to EBITDA multiples, and enterprise value to EBIT multiples. EBITDA by far the most common. You may have heard of other multiples, specifically equity-based multiples like price to earnings, price to book. Those are useful in traditional valuation settings. In restructuring, though, equity valuations are less relevant, and the predominant approach is enterprise multiples. Multiples facilitate comparisons for companies of different size, valuation of private companies, or companies with limited availability of financial information. So that's something that that's easier to do than if you were to build a DCF, for example. And it provides that market-based sanity check to intrinsic valuation. And the intuition here is the market is efficient on average, but may be off when pricing individual assets. So advantages of comps. It's easier, quicker than the DCF. It captures actual market valuations. The disadvantages are the bankruptcies are always unique, which makes comparisons to other companies less meaningful. It's always comparing apples to oranges. It's sensitive to selecting correct comps and metrics. And just to be clear, a comps analysis in our example would have been very simple. We simply would have said, what's the EBITDA of our business today? Apply some EBITDA multiple to that and figure out, well, that's the and say that's the value. I mean, it couldn't be any simpler. The challenge is, of course, where do you get that EBITDA multiple? And usually it's done by looking at comparable companies and figuring out how they're trading on the market, at what multiple of EBITDA they're trading on the market. And that's the challenge here. Since bankruptcies are unique, finding comparable companies and looking at and applying their EBITDA multiples to this distressed business is going to be challenging. So truly selecting comparable companies and also making sure that the multiple itself is scrubbed. We're going to talk about that in the next slide. Is very important. Scrubbing the multiple means, EBITDA should exclude non-recurring items and should be calculated consistently across all companies. And so EBITDA is a non-GAAP measure of profitability. So different companies lump different things in EBITDA. And so one of the things that we want to make sure that when we're comparing the EBITDA multiples of various companies, we want to make sure the enterprise value EBITDA multiples of various companies, we want to make sure that the EBITDA that we are comparing is an apples to apples EBITDA. And what that means is we have to take care to make sure that EBITDA excludes across the board certain things that are maybe considered non-recurring. These are things that especially companies in distress generate. They generate certain expenses that are not expected to recur in the future. So we want to make sure that all the EBITDAs of all the comps and the company that we're looking at excludes things like severance costs associated with the restructuring, professional fees, any inventory write-downs that would affect expenses, operating expenses, any goodwill impairment expenses, uncollectible accounts that have been written off, any other restructuring costs, gains and losses on sales, costs associated with facility closures, severance costs, and other restructuring expenses, as well as one-time legal settlements. If these are not excluded and left to skew the future cash flow potential of the company, the multiples derived valuation will understate value. And so it's important that we scrub the EBITDA numbers. In our modeling course that's coming after this primer, we're going to spend a little bit of time making sure that our case study's EBITDA is quote-unquote scrubbed to exclude all of these items.